your initial reaction to the data we had around about 33 minutes ago?
As expected, John, for the reasons Mike McKee just pointed out, we are slowing in terms of the recovery, and the components that are slowing the most are the ones that involve engaging outside. So the stay-at-home buying is continuing, but unfortunately, with what's been happening on the health side, we're seeing less involvement in the economy as a whole. So it is really consistent with the square root sign of what's going to go on, especially if we don't get actions from Congress on unemployment benefits.
Well, Mohamed, the month of August is going to be a really interesting month. The enhanced unemployment benefits ended in July, at the end of July. What are you expecting this month?
A significant slowing, unfortunately. What the data tells you is this is a very resilient economy. And so far, the consumer has been both willing and able to power us through what otherwise would look pretty dark. But part of that ability to power us through is through income support. So I'm worried that we are going to see a significant slowing in August, and depending on what happens in the next few weeks, even in September.
Mohamed, do you think we're making a satisfactory handoff away from fiscal help, fiscal aid, towards a self-sustaining recovery?
Not as yet, John. You know, we have three issues. One is the health emergency, and how well do we understand it, and how can we counter it? The other one are the changes in the economy. But the third one that we hardly ever talk about is behavioral issues. Informed people, are they aligning their risk assessments with what's consistent with society? Are they acting in a way that allows us all to live with COVID in a healthy and economically productive way? And that is proving to be a huge challenge, not just here, but increasingly around the world as well.
Well, let's talk about the rest of the world. I think two of the most important, interesting data points of this week so far came out of the UK. The UK economy contracted more than 20%. That's the one data point. The other is the unemployment rate of 3.9%. Mohamed, you can't reconcile the two things without understanding the fiscal help that has been offered to people who are still considered employed. And we face this really important decision now. We continue on with fiscal policy this way and carry on trying to help people who can't get a job, or we try and wean this economy off the stimulus. Mohamed, how difficult is this moment now for policymakers?
It is really, really hard. Everybody went into this, and I'm going to use game theory terminology, not because I think this is a game. This is really serious, but game theory terminology gives you really good insights. Everybody went into this thinking it was a one-round game. You get hit with the virus, you deal with it, you support everybody, and then we go back to normal. Now we're finding out it's a multi-round game, and multi-round strategies are very different from one-round strategies. And that is what the UK is discovering. This is really hard decisions. And remember, John, there are four things that government should be doing, not just relief, which is what we're talking about, but also making sure we can live better with COVID, also making sure that we take action to counter the increase in household economic insecurity, and also be careful of deglobalization, be careful of industrial concentration. All that is going on, and is going to be a further headwind to growth over the long term. So this is really hard for governments, and they are struggling in the first bucket, let alone the next three.
Mohamed, you said it's a multi-round game for policymakers. Is it a multi-round game for market participants?
John, so far, all that matters for participants is the following. Do I have confidence in the reliable and ample provision of liquidity by central banks? And as long as the marketplace says yes, you're going to go up higher, and you're going to decouple more and more from economic realities. But I keep on telling people, favorable technicals are a necessary condition for you to do well, but they're not sufficient over the long term. You're going to need a handoff. And you see this week, the market struggle with what theme am I pursuing underneath the liquidity theme? Am I pursuing the reopening theme, as we did earlier this week, or am I pursuing the stay-at-home theme, as we did later in the week? They alternate between themes, but as long as there's confidence in the support of central banks, these market technicals can take us quite a long way until you get a big shock. And then we're going to find out if that happens, and I hope it doesn't happen, but if that happens, that we've overshot.
What I think you're hitting at is testing that confidence then, Mohamed. So build on that. What are you looking for that you think could test the confidence that people have in the policymaker?
So people expect central banks to do more. The whole narrative about the Fed, for example, is they're going to do more on forward guidance. They're going to do more on QE. So there's this notion that the central banks will continue to do more of the same, regardless of whether there's a handoff to fiscal or not. And it puts central banks in a lose-lose situation. If they don't do more, they can be responsible for a market sell-off that undermines the economic recovery. But if they do more, there's just exaggerating the decoupling. So this is a really tough environment, and people should always think a little bit about risk mitigation in this context.
Risk mitigation how, Mohamed? Because that's a conversation that's come up repeatedly in the last several weeks. How do you mitigate risks in this market, the best way of doing it?
So, as we've discussed before, and that has to do with what's been happening to gold, it has to do with what's been happening to investment grade, what even is starting to happen to high yield. People have realized that government bonds are not the risk mitigator they used to be, that the price risk is so asymmetrical that they have to do something more. And we've seen people migrate to a bucket of risk mitigators. And what's the irony in this, John, is the bucket of risk mitigator includes risk. So it's not just gold, it's the front end of investment grade, and some are even seeing the front end of high yield as being part of this risk mitigation bucket. And it tells you the extent to which markets have been distorted by the involvement of central banks. People now think that risky assets are risk-free in their portfolio.
Mohamed, before we let you go, I want to talk about the consensus. Coming out of the last crisis, the consensus believed that rates would go up in the next couple of years. Some people were really worried about inflation because of the unprecedented stimulus we were getting at the time from global central banks. Now the consensus is, conditioned by the past, that rates are going nowhere for a long time, including at the long end, not just the front end, and that disinflationary forces will be the dominant force through the next several years. Any reason to believe that won't be the case?
Well, first of all, it's really fascinating to see what's been happening to real rates. And apart from this week, which seen us go back to levels of nominal yields that we haven't seen for a couple of months, what really drove real yields down wasn't a collapse in inflation expectation, was the pressure that central banks put on nominal yields. So inflationary expectations have started to creep up, and the latest data is consistent with that. John, look, it is really hard because if you just look at the supply side, you would be worried about inflation. But it's the demand side that's making this consensus so strong. People simply don't see demand coming back in a huge way. And that's why that is. I think it's an open question. I think if you look beyond a year, it's an open question whether we get inflationary pressures or not. I just hope we don't get stagflation. That would be the worst of all world for markets and, of course, for households.